Imagine holding the title to a $60 million aircraft, managing global properties, and controlling immense corporate power, yet paying your taxes at a fraction of the rate applied to a middle-class American. We expect the U.S. tax system to be progressive. The more money a person brings in, the higher the tax bracket they are supposed to occupy. But the system applies differently depending on the source. Most Americans rely on traditional paychecks. The ultra-wealthy bypass that structure entirely by building their net worth through assets. An asset in this context is anything that holds intrinsic value: shares of stock, ownership of entire businesses, real estate portfolios, and long-term private investments. The crucial detail is how the IRS treats these holdings. The government levies taxes strictly on realized income, money that is actively paid out. It completely ignores the passive, quiet accumulation of vast wealth sitting on a ledger. By defining taxable income this way, the tax code establishes the exact legal framework that allows the world's wealthiest individuals to avoid paying a percentage on their true financial growth. Let's trace how this works in practice. Suppose a founder takes their company public on the market, and the total value of their personal shares reaches $50 billion. This chart shows a massive, continuous increase in that company's stock value over time. But notice the flat line at the bottom. Because the founder hasn't actually sold any of those shares to a buyer, they have only generated what accountants call unrealized gains. As far as the IRS is concerned, 0 taxable events have occurred, which brings up an obvious question. If they never sell their stock to generate cash, how do they actually pay for multi-million-dollar estates or private flights? They borrow it. Major banking institutions look at those billions in unsold stock and gladly accept them as collateral. The bank issues a massive, low-interest cash loan backed by the shares. The founder now has millions in spending money. And under the U.S. tax code, borrowed money is completely exempt from being classified as income. By pairing unrealized gains with tax-free loans, the ultra-wealthy successfully sever their massive financial growth from any immediate tax liability. Eventually, loans come due, or an investor decides it is time to cash out. When the ultra-wealthy finally do sell their assets for a profit, they re-enter the tax system, but they still don't pay the standard income tax rate. Instead, profits made from holding an investment for over a year are subject to the capital gains tax, a specialized rate that is significantly lower than the highest income brackets applied to ordinary labor. The economic logic behind this lower rate is to reward risk. The theory insists that by taking less tax from investments, people are encouraged to put their money into new ventures, which supposedly stimulates job creation and drives innovation. The actual outcome is starkly different. Because the top fraction of Americans hold the vast majority of the nation's corporate stock, the benefits of the capital gains rate are overwhelmingly concentrated at the very top. This split-screen graph compares the trajectory of wealth generated through investments versus daily wage labor. When you tax investment at a lower rate, the asset owner compounds their money at exponentially higher levels, aggressively widening the wealth gap every single year. The math is entirely straightforward. The current structure of the tax code penalizes working for a living and heavily subsidizes owning assets for a living. It is crucial to note that tax evasion, hiding money illegally, is a federal crime. The asset borrowing and capital gains strategies we've outlined are entirely legal forms of tax avoidance. They are the result of a massive industry of specialized accountants, estate planners, and tax attorneys whose sole job is to navigate and exploit the exact wording of the law. This reality has sparked intense debate in Washington, where a specific political solution is gaining momentum: the wealth tax. A wealth tax directly targets the unrealized gains loophole. Instead of waiting for a billionaire to sell their stock, the government would annually tax a small percentage of their total estimated net worth. Proponents argue that capturing a fraction of this extreme wealth is the only way to adequately fund modern public services and stabilize an economy that has become dangerously imbalanced. Opponents argue the plan is unworkable. They point to the sheer logistical nightmare of trying to accurately assign a specific dollar value to private companies and illiquid assets every single year. Furthermore, they warn that taxing unrealized wealth forces successful founders to liquidate shares of their own companies just to pay their tax bills, penalizing growth and potentially driving innovation into other countries. Ultimately, every tax system is a reflection of a nation's priorities. The mechanisms the ultra-rich use to legally shield their billions are operating exactly as the laws allow. It is up to the public to decide whether that ledger is functioning as the engine of the economy or exposing a systemic failure.